Okay, ladies and gentlemen, I have to apologize. We had no audio. So we have audio now. Hopefully you guys can hear me. I'm going to go ahead and back up to the very beginning of the presentation. Thank you all for joining. A couple housekeeping items. Number one, everybody is going to get a copy of today's presentation. So check your email about an hour after the presentation. You will have an email sent from the system with a copy of today's material. Housekeeping item number two, if you have questions or comments during the course of the presentation, all you need to do is type your question into the dialog box and it will pop up on my computer screen. I will answer all questions as they are appropriate. Now, it looks like some of you have figured that out, so thank you very much for letting me know that there was no audio, and hopefully everybody can hear me now, so I apologize for that. Today's presentation is growing your business with 1031 exchange. And your presenters are both myself and Tim McCullen, sales manager at Cornerstone Title. Now, the reason why we have two presenters today is because when you're going to grow your business through 1031 or when you're going to grow your business at all, you need to have the right partners. And what we're going to do today is talk to you about our knowledge base and how it can help you increase your business as a real estate professional. So with that said, I'm going to give you just a little bit of background about my company. We are a 1031 exchange accommodator. And for those of you who have done 1031 exchanges before, you know that 1031 exchange accommodators do three very important things. Number one, we hold all of the sale proceeds that is a result of the sale of an investment property, right? When a client does an exchange, they can't touch their money. So the funds come to the 1031 exchange accommodator. The 1031 exchange accommodator also prepares all the legal documents that properly documents the transaction as an exchange. And then number three, we make sure that you are in compliance with the tax code as it relates to 1031. All right. So our company, my company, has been doing this for a very long time. We have been around, I've been around in the business since 2001. I established this company back in 2006. As an accommodator, we do about 150 deals per month. So we've basically kind of seen everything and done everything in the exchange business. So we've been around, we know the tax law very, very well. And as a partner in this field, we're going to be a top-notch partner for you and really help you as an subject matter expert in the 1031 exchange process. Now, of course, this 1031 exchange presentation, or this presentation today, is not so much about just telling you about what a 1031 exchange is and going into the tax law. It's really how you can use 1031 exchange to grow your business, right? So most of you are thinking, well, geez, it's 2020. How am I going to go out and duplicate my success from last year or beat what I did last year in terms of your overall sales numbers? Well, if you're going to, you've got to think outside the box, right? So most of you, if you're not if you don't have 1031 exchange as a big component of your business, I'm going to give you the magic bullet, the magic formula right now, okay? How do you grow your business with 1031 exchanges? Well, you market to and you work with investors. Pretty simple, all right? Now, the investor market is about 10% of the housing market, okay? There are statistics from CoreLogic that show that the number of homes, not apartment buildings, obviously, not office buildings, but just the number of homes bought by investors is at historic highs right now. So we have seen a dramatic increase in the number of investors going out and gobbling up homes. And if you're not marketing to investors, well, right away you're missing out on at least 10% of the market. Now, in some areas, it's as high as 20%, 25%. Now, that's not in California, but if you go out to Arizona or Detroit, there are 20 to 25 to 30% of the homes being gobbled up by investors. So again, the investor market base is an increasingly important part of the the real estate business. Now you might be thinking, well, geez, it's those big companies that are going out and gobbling up all of the homes, because you've seen that in the press, right? Well, that is actually incorrect. Mom and pops account for about 60% of all investor activity. Now, why do you want to work with a mom and pop investor? Well, if they are investors and they're doing 1031 exchange, these are going to be your best repeat clients that you have. Okay, the average homeowner that you work with moves once every 7 years, and that's according to the California Association of Realtors. The average client that I work with in my 1031 exchange business, I work with them repeatedly, on average, once every 3 years. And some of them I work with every single year, multiple times a year. I have some clients that are always buying and selling. So if you are missing out on the investor market, you are missing out on people who are doing a lot of deals. They will be great, fantastic repeat clients. And they are people who are generally trading up in value all the time, right? Because that's one of the rules of the 1031. You're going to trade up in value. You might start with a $200,000 sale, but then you're going to go to a $400,000. You're going to go from the $400,000 to an $800,000, from the $800,000 property to $1.5 million property, right? Those are very good clients to have, and we're going to show you how to reach out to them today. Now, if you're going to talk to an investor about doing business and representing them as a real estate agent, you're going to need to think like an investor. And here is how investors think. Trust me, I work with them every single day. When they look at real estate, they think, geez, is this a good investment? Right? What makes real estate a good investment? Well, real estate, unlike the stock market or the bond market, has 4 components that make it a fantastic investment, right? You've got properties that produce income. You have leverage and appreciation. Real estate is a hedge against inflation. And really, what I specialize in here is the tax advantages of real estate. So let's go ahead and just talk about these real quickly. Income, right? I think everybody knows that the national average rental evolution has been going one way. Now it's starting to turn just slightly because we've had a crazy run up, but we have seen rents increase everywhere, right? Everywhere across the country, we've seen this trend line. Now here in certain cities like San Francisco, San Jose, rents have been out of control, right? The top highest rents are in Manhattan, San Francisco, Boston, Brooklyn, and San Jose. So we have seen investors who have owned property for a long time just have fabulous rental increases over the last several years. Now, it is softening, right? So we're seeing a little bit of a softening in certain markets because we've had just such a crazy run up. But income has been a phenomenal part of owning real estate, not just appreciation, income. So don't forget that. Now, the other thing, what makes real estate a good investment? Leverage and appreciation. Okay, leveraged appreciation is a phenomenal thing, right? I can go out and I could buy $1 million property and get 10% appreciation, and what I see is that property is worth $1.1 million. But when we talk about real estate, most investors do not buy their properties all cash. Most investors are using leverage or getting a loan to buy the real estate. And what that means is they are seeing outsized returns compared to the stock market, right? So if I went out and bought $1 million property and I only put 10% down, but if the property appreciated, well, that's 100% return from a cash on cash perspective. Now, no lenders are allowing you to put 10% down anymore, especially on investment property. So the kind of more likely scenario would be a 20 or a 30% down payment. But when you were looking at real estate, you put 30% down and it appreciates 10%. Well, still what you're seeing is a 33% cash on cash return. That is fantastic. And a property going from $1 million to 1.1 is not unrealistic. So what you're seeing is people say, well, geez, is the stock market better? Is the real estate market better? Well, it depends, obviously, on what property you buy, how much you put down, and what the property appreciates. but these are not unrealistic numbers. So if your stockbroker is saying, oh, you can never beat our returns, real estate only goes up 3% per year, I don't believe it. I don't believe it. Okay, real estate just on average is going to be a fantastic investment because number one, you're going to get income. Number two, you're definitely going to get appreciation over the long term, but you're going to get leveraged appreciation, which is something that the guys on Squawk Box on MSNBC don't usually talk about. Number three, hedge against inflation. Okay, don't forget this, right? When you are buying real estate, if you've got a fixed rate mortgage, your property value is going to rise, your rental income is going to rise, your mortgage payment remains the same, and you're repaying the loan with cheaper dollars with every year that goes on, especially in a very inflationary environment. Now, is inflation going to happen? Who knows? We've been in this weird zone where inflation has been flat for a long time, but generally, if people are worried about inflation, real estate is a good place to park your funds. Now, let's get into the meat and potatoes of this presentation, right? The tax advantages of owning real estate. It is not a coincidence that every millionaire and billionaire has a huge percent of their wealth tied up in real estate. And they do it because of the tax breaks that you get when you own real estate. Now, tax breaks come in the form of when you own real estate, there are significant tax breaks. And also when you sell real estate, there are significant tax breaks. Let's talk about the tax breaks that you get when you own property. All right. When you own real estate, 100% of your interest on a rental property is deductible. You also get to deduct all of your expenses. When you own real estate, you have a business. Okay, and as you run your business, you deduct the expenses of running that business. What are some of those expenses? Well, you've got professional fees, rental of equipment, rents you pay to others, repairs, supplies. You guys know these, right? One of the fantastic things about owning real estate is that you can deduct your travel expenses. I have clients who will buy property in places that they like to or have to visit. I'll give you an example. I have a client who loves going out to Hawaii. So her last 1031 exchange was to a rental property in Hawaii. Now, when she goes to Hawaii to manage her rental property, guess what? She's got a tax write-off. I have some clients who have kids that go to Arizona State University. And you know what they did? They bought a rental property for their college kid to live in while they were at the university, and every time mom and pop went out there to visit, they wrote off their travel expenses. Now, there's certain limits. You have to be reasonable, but these type of expense deductions are very important for real estate investors because you can write them off. Now, let me show you their power. Let me show you the power of the expenses. But before I do, I also want to talk about depreciation. What is depreciation? Well, depreciation is accounting for the wear and tear of the property, right? Building's going to fall apart over time. So the government allows you to account for that. Now, when you buy real estate, not all of it is going to fall apart. Some of it is land, and land does not fall apart. So the government says, if you go out and you buy $1 million property, you got to take out the value of the land, and then you can depreciate the remaining value of the building. All right. So here in my example, I've got $800,000 worth of building value. The government says you can depreciate that over 27 and a half years. Now this, ladies and gentlemen, is very important because let's go ahead and assume that it costs me $7,000 a year to manage the property, and I've got a couple trips to visit it, and then I'm going to keep track of that. So I've got $7,000 of deductions right off the bat, but before I figure out all of my deductions, I have to also account for my depreciation. Right? So the depreciation is a deduction. What I do is I say the building value divided by the number of years the government allows me to depreciate gives me a yearly depreciation of $29,000. So I have two very important write-offs. I've got my expenses, my out-of-pocket expenses, and then I've got my depreciation expense. Now, did I actually spend $29,000? No, I didn't, right? That is a phantom expense. The government allows me to take that. It's not something I'm coming out of pocket on. Now, is this important? Absolutely, because my expenses and my depreciation are written off against my rental income. So if I have a building that is producing $3,000 a month, at the end of the year, I have collected how much in rent? $36,000. Now, normally, if I make $36,000 of income, the government is going to tax me on it. But remember, this is real estate. So before we pay taxes on our rental income, we are going to deduct our expenses and we are going to deduct our depreciation. How much is my taxable income after all of my deductions? 0. So how much money is the government getting from my $36,000 of rental income? Absolutely nothing. Ladies and gentlemen, this is powerful. And again, it's part of the reason why wealthy individuals will buy up real estate. In fact, during the 80s, there was real estate transactions that were put together simply for these expense and depreciation write-offs. Now, it got into obviously a mess because of the way the tax rules were written, but these are very powerful tax breaks. Now, what happens if my expenses go up one year? I've got to pay $10,000 for a bunch of items because the tenant moved out and left a mess and blah, blah, blah. Well, in a year that you have high expenses, obviously you have to pay for those, but what it's going to do is it's going to produce a loss. And ladies and gentlemen, these losses are called passive losses, and they offset passive income from your other properties. Or if you're a real estate agent, get this, if you're a real estate agent, passive losses can offset ordinary income. Let me repeat that. If you're a real estate agent, you're a full-time real estate professional, passive losses can offset ordinary income. So if you made $100,000 at your job at Remax, but you've got a $10,000 loss on each of your 10 properties, guess what? You're paying absolutely no taxes. This is very important. Absolutely very important for all of you to understand. It's not rocket science, okay? We're just taking our rental income, we're deducting our expenses and our depreciation to get a number that's hopefully close to 0 or below. Does that make sense? All right, now you're thinking like an investor, okay? Now you're thinking like an investor. I want to go out and I want to own a bunch of real estate. Tax breaks are fantastic in owning real estate. Well, guess what, ladies and gentlemen? It does not end there. Tax breaks continue because when you sell real estate, depending on the type of real estate you sell, you're going to have phenomenal tax breaks available to you as well. If you sell a home, everyone knows this, you get your homeowner's exemption, right? We're not going to go over that. But if you sell a home, you get your homeowner's exemption. Well, guess what? When you sell investment property, you've got a tax break. It's almost as powerful. The tax break is what my company specializes in. It's called Section 1031, and it is tax deferral on the sale of your investment property. Let's talk about how 1031 exchange works. All right, 4 basic guidelines for a 1031 exchange. Guideline number 1. In order to qualify for the tax deferral on the sale of your investment property, your property must qualify. How does it qualify? Well, number 1, the property must be held for productive use in trade or business. And number 2, the properties involved in an exchange must be like kind. What does that mean? Well, it's pretty vague, ladies and gentlemen. When you need to qualify or want to qualify for an exchange, all you have to have done is held your property as an investment for at least 1 to 2 years prior to the sale. So you could have a home that you've lived in for 20 years. You can move out and you could put a tenant in there. You could season that property as a rental for 1 to 2 years. And then when you sell it, you could take advantage of 1031. You can have some farmland. Okay, you could farm on the property for 10 years. And you could be sick of farming and say, you know what, I want to sell the land. You could do an exchange. Now, when you do the exchange, you can go into any type of replacement property that is like kind. All investment property anywhere in the United States is going to be like kind. Very, very vague. So you can sell land in Fresno. You can exchange into a rental house in Arizona. You could sell the rental house in Arizona and get into an apartment building in San Jose. You could sell the apartment building in San Jose and buy into an office complex in New York City. Any type of investment real estate that is held for investment purposes, and if it's in the United States, it's going to qualify. 2 exceptions. Number 1, can't go out of the country. Foreign property is not like kind. Number 2, flippers. Guess what? People who flip, quick flips, are not eligible for 1031. Why is that? Well, I hinted at the reason, right? I hinted the fact that you need to own it for a year or 2 in order for it to be exchangeable. What the government wants to see is your intent to use the property as an investment. And if you can prove that intent by having a renter in the property for 2 years, you're not going to have a problem with the IRS. However, if you buy a property today, you fix it up, and you sell it 3 months later, your intent was to use that property as inventory. Inventory is not exchangeable. Inventory is something you buy with a specific intent to sell. Inventory is not exchangeable. All right, rule number 1, make sure your properties qualify. If you have questions, pick up the phone and give us a call. You're not quite sure, you held it long enough, you think you might have a little problem with the IRS because of the way you used the property, just pick up the phone and give us a call. And ladies and gentlemen, I do see your questions. I've got a couple really long questions here that are hard to read while I'm talking, so I have to apologize. And I know that Prem, you've asked a bunch of questions, and I'm going to get to all of those at the end of the presentation. So keep your questions coming. It's just I've got so many now that it's kind of I'm going to have to defer on most questions to the end. All right, rule number 1, make sure your properties qualify. Rule number 2, when you do a 1031 exchange, if you don't want to pay taxes, I need you to do 2 things. Number 1, reinvest all of your cash. Number 2, purchase property equal or greater in value. If you sell a building for $1 million after commission and closing costs, right? $1 million after commission and closing costs, and you don't want to pay taxes, what do you need to do? Well, you need to buy a building for $1 million or more. All right, it's pretty simple. All of your cash from your sale is going to come to who? The 1031 exchange company. All of that cash needs to be the down payment on the property you're buying. All right, so you just sold a building for $1 million. I'm going to get a bunch of cash in the exchange account. You're going to use that cash as a down payment, and you're going to buy property for $1 million or more. Now, some of you might be thinking, well, geez, can I sell 1 property and buy 2? Absolutely. Can I sell 1 property and buy 5? Absolutely. Can I sell 2 properties and buy 1? Absolutely. You can structure multi-property exchanges, not a problem. I have one guy who called me yesterday and said, I'm going to sell a property in California and I'm going to buy 27 out of state. Actually, he said 25 to 30. All right, you can do that. Some of you might be thinking, well, geez, when I sell this property for $1 million, I want to go out and buy myself a new car. So can I take 50 grand, put it in my pocket, and just reinvest the rest? Absolutely. Okay, the problem with that is you're going to pay taxes on the 50 grand. Not the end of the world. You can do a partial exchange. That's fine. However, if you don't want to pay taxes, what do you need to do? Well, you're going to need to spend all your cash and purchase property equal or greater in value. Rule number 3. Everybody knows this. When you do a 1031 exchange, you have a time frame to contend with. Your time frame is pretty simple. There is no flexibility. The government does not give you extensions. You can't call the IRS and beg, plead, and say, oh, I was sick. I missed my deadline. They don't care. All right? Your time frame is this. When you close escrow, your time for your exchange starts. Close of escrow is day 0. You have 180 calendar days to go out and complete the exchange. And what does that mean, ladies and gentlemen? Completing the exchange means what? It means you buy your replacement property, right? So you got 6 months to buy replacement property. No problem, right? Wrong. Because what do you have to do on day 45? Well, day 45, you're going to have to identify what you're thinking about buying. The government says, hey, you're going to sell something and buy something. Well, we want to know what you're thinking about buying, and we want to know on day 45. Well, how do you tell the government what you're thinking about buying? Well, you're going to submit an identification letter. And this is our 4th and final rule for the 1031 exchange. You're going to submit an identification letter, and there are 2 ways to do that. You can fill out the identification letter, which we provide for you, using the 3-property rule. The 3-property rule says what? I know some of you know. You can put 3, 1, 2, or 3 properties on your list. Now, the 3-property rule is what most of my clients will use, because most of my clients will sell one and they'll usually buy 1, maybe 2, right? And then they'll have a backup. Now, the problem with identification is that once you identify on day 45, you absolutely have to buy something from that list. So on day 45, you submit your list. And then on day 46, this property gets sold to someone else. Can you replace it? No. Day 47, the second property burns to the ground. Can you replace it? No. You're stuck. You got 1 property left. And if you cannot close on that last property that you've identified, you have a failed exchange. Now, what happens in a failed exchange? Well, not the end of the world. You just pay your taxes, okay? It's not the end of the world. Sometimes you just have to pay your taxes. Sometimes buying the wrong property to try to save your exchange is the worst thing you can do. All right, so very important though, day 45 is when you have to identify. Now, some of you who are sharp are sitting there thinking, well, geez, Leonard, you just told me a couple minutes ago you have a client who's going to buy 25 properties. How the heck are they going to do that if they can only identify 3? Well, remember I told you there's a couple ways to identify. The first way is to nominate 3. The second way to identify is called the 200% rule. Now, hear me out because this confuses some people. With the 200% rule, you can identify as many properties as you want. However, the combined value of all of these properties cannot exceed 200% of what you sold. So, with the 3-property rule, you have a limit on the number. With the 200% rule, you have a limit on the value. Let me give you an example. You sold this building for $1 million. Using the 200% rule, you can now identify $2 million worth of real estate. Now, if you stay in California, that's going to get you 2 properties. But if you go out to Detroit, that might be 25 properties. So the 200% rule is a fantastic tool for people who are selling very expensive property and want to go out of state and buy a lot of really cheap properties. I talked to a guy in Florida who bought a property for $47,000. I actually had to look it up on realtor.com because I didn't believe that you could buy property for $47,000. But they're out there. All right? And some of our investors are making them work. They're buying a ton of them and they're getting great cash flow. So, ladies and gentlemen, there you have it. That's how you do an exchange. Now, obviously, that's kind of high level, right? There's a million things I can go into it, a lot of nuances, but this presentation is how to grow your business through 1031 exchange. And the most important thing to do when you're wanting to grow your business through 1031 exchange is to understand how investors think. Because once you understand how investors think, you can start to have conversations with them about helping them transact business. So let's talk about why investors do 1031 exchanges. We already talked about why investors buy real estate, right? Because of those four things, right? What makes real estate a good investment from an investor standpoint? Well, what makes 1031 exchange attractive to investors? Well, number one, investors love exchanges because everybody loves an opportunity not to pay taxes, right? So people are doing exchanges because if they don't, they pay taxes. And did you know that in California, the tax rate is about 33%? So you have a client who's thinking about cashing out. What you should do is tell them, well, geez, if it's an investment property, your tax rate's going to be about 33%. And you can quickly tell them how large their tax bill is going to be. You don't have to know accounting. You can just say, hey, what'd you buy the property for? And what are you selling it for? The difference is their profit, and about 33% of that goes to the government. Now, that's kind of high level, right? There's a lot that goes into it. But if you tell a client who bought a property for $100,000 and they're selling it for $1 million, that their tax bill is going to be about $300,000, that is going to be a pretty accurate number. Now, the client learns that and they say, well, geez, I don't want to pay that. And you say, well, there's a solution. You do a 1031 exchange. Okay, that makes sense, right? Clients do these exchanges because they want to keep the money that they've earned in their pocket and not give a third of it to the government, right? So very important why investors are doing exchange, right? They're always doing it because they don't want to pay taxes. Now, but there's some other reasons. People do exchanges because they are interested in building wealth. The goal of all of my investors is not to sit on a $47,000 property for 20 years or forever, right? The goal of our investors is to accumulate wealth through real estate and trade up into bigger and better properties. So they are doing that by using 1031 exchange to keep their money in their pocket and use that money to go out and get into bigger and better or more properties, right? All of our investors, all of my investors are using the tax code to their advantage to build wealth. Now, some of my investors are already very, very wealthy. And some of those investors say, you know what? I'm not worried about building wealth. What I'm worried about is protecting my wealth. And the best way to protect your wealth, whether it's the stock market, the real estate market, the bond market, is to do what? Diversify, right? Don't put all your eggs in one basket. If you own all of your real estate in San Francisco and you've got a $20 million portfolio and there's an earthquake, God forbid, you could lose your entire wealth. So what do people do? Well, they diversify. They go and they sell property in San Francisco and they get into Fresno. They get into Arizona. They go into different areas. They go into different types of real estate. In case there's a recession, all of their office buildings are empty, right? They get into out of office buildings into apartments. You diversify to protect your wealth. And it's a fantastic reason to do an exchange. Now, if you are a sharp person, which I know every one of you are, you're sitting there and you're thinking, well, geez, I've got some clients who could probably diversify. Well, guess what? Pick up the phone and call them and say, hey, we're kind of at a high point in the market. Have you guys thought about getting out of your building in San Jose and into maybe a different market where you might see better appreciation? You can diversify, and this is going to help you protect your wealth. Now, if you don't know people who need to diversify, guess what? I've got a guest speaker coming on in just a few minutes to talk about how to find those people, how to use the title company resources that are available to you to find clients who need to diversify. All right? Now, last thing I want to talk about, long-time ownership issues. I have clients who are 85 years old, and the last thing that those clients want to do is manage real estate. Okay? Those clients just want to get out of property because they hate dealing with the toilets and the tenants and the trash. But they're afraid to do anything because they don't want to pay taxes. Well, guess what? Those people are perfect for you to have a conversation with and say, let me sell your building or your house or your rental, and let's exchange into something that you don't have to manage. Well, what is that? Well, it could be a triple net lease Chick-fil-A. It could be 1/10 ownership of an apartment building that's run by a professional company. Okay? There are solutions out there for your older clients who are just sick and tired of dealing with the management burden that comes with owning real estate, but they're too afraid to do anything because of the tax bill. Well, guess what? They can exchange into properties that are easy or management free. Okay, there are solutions out there. And then the last thing, okay, real estate owners will do exchanges when they've owned property for a very long time simply because that property has become fully depreciated. I've had clients who I've talked to on the phone and they said, hey, why did you decide to sell this property? It looks like you've owned it for a long time. And they said, well, geez, my CPA told me to. Well, what do you mean? Well, CPA said the property was fully depreciated and I'm not getting that write-off anymore. So what I'm going to do is sell this fully depreciated property and trade into a new property with incremental value so I can get new depreciation schedules. Remember that write-off I talked about 10, 15 minutes ago, that depreciation benefit? Well, if it's gone, you're paying more taxes on your rental income. If you can exchange into a new property with new incremental value that you can depreciate, boom, you've got that depreciation benefit back, and you're paying less of your rental income to the tax man. Ladies and gentlemen, these are very, very important reasons why my clients do their deals. And you should all be thinking, well, geez, I can benefit from this because now I can have conversations with clients about diversification and relief of management burdens, right? These are reasons for you to go have active, good conversations with your existing with your existing clients about possibly listing and selling their property. Now, Tim's going to come up soon and talk about, if you don't have clients, how to get them. He's going to show you some actual lists that he's going to run for you. And we're going to give you some letters. You don't even have to write a letter. You want to do some of this marketing? We're going to give you a letter to send. And there's 3 different letters that we've created, and you could tweak them as much as you want. Some of my clients don't even tweak them. They send them out as is, right? So if you're looking to build your business through 1031 exchange, the first thing you got to do is you got to find the investors, okay? We're going to help you do that. We've got the title resources that can pull from the tax roll database and show you people who have owned property for a long time, right? We can show you people who own 5 or more properties in the same town, and guess what? Those people might need to diversify. Okay, we can show you people who live in Florida but own property in California and have to travel back and forth to try to manage them. Those people might not want to do it. And we can look, and Tim can tell you how long these people have owned the property. If they've owned it for 30, 40 years, guess what? They're probably 70 years old. And when you're 70 or 80 years old, managing property is just a pain in the butt. It's a pain in the butt, and I'm 47. Let alone if I was 77, I wouldn't want to do it. So we're going to talk about farm lists soon. Tim's going to get on. But before I pass the mic over to Tim, I think it's very important when you're marketing to provide your client solutions. So I think I said the magic to marketing to investors, the magic in terms of using 1031 exchange to build your business is knowing investors. But it's not just knowing investors. It's providing investors solutions. All right. If you can tell a client, hey, you own this property in San Francisco and it's worth $1 million, and I know your cash flow is about this. What if I could show you a way to move that $1 million into a different market and triple your cash flow? Do you think the investor is going to listen? Well, you probably get 5 minutes from them, right? That's better than what you had before. All right. And when you're marketing to investors, I want you to think solution. Okay. I had a client who had a $2 million property in Los Altos, and I swear it looked something like this. This is not the actual property, but it was pretty close. Right. The client said, I'm selling this $2 million property. It's a terrible property to manage. It's falling apart. And what I want to do is I want to get into something shiny and new that I don't have to worry about. Okay, that's providing solutions. If you came to my client and said, listen, I can get you out of your shack and into something shiny and new that's not going to have to require any management, you're going to get 5, maybe 10, maybe 15 minutes of my investor's ear. And hopefully a listing for $2 million and a nice commission out of that. All right, providing solutions. Keep that in the back of your mind. That's what my investors want to hear. They don't want to hear that you're the greatest listing agent in the world and that you can give them a free valuation of their property. Every agent can do that, right? Zillow can do that. What they want to hear is that you can provide a solution to pain that they have. And the pain is simple. If they're old, they don't want to manage. If they're rich, they need to diversify. If they're fully depreciated, they need new depreciation schedules. Now, I'm going to pass the mic over in just a second, but one of the greatest things that ever happened to me after a presentation was this guy. I gave this presentation probably 15 years ago to Jerry and his team. And about a week or two after, might have been longer, the presentation, Jerry sent me his business card and he said, Leonard, look what I did. I said, what'd you do? He said, I added 1031 exchange specialist to my business card. And I said, Jerry, that is fantastic. And I said, Jerry, how you qualified to be a 1031 exchange specialist? And he said, Leonard, I took your class and I know you, and that's good enough. And ladies and gentlemen, that is good enough. You can market yourself as of today as a 1031 exchange specialist because guess what? You took this class and you know me. If you have any problems talking 1031 exchange to anyone, the first thing you're going to do is pick up the phone and I'm going to solve your problem. Okay? I've been in this business for a long time. There is not an investor who knows 1031 better than me. I don't care if they've done 1 million deals. Okay? I've done more. I don't care if they sold $10 billion worth of real estate. I've done more. All right? Because it's all I do every single day for 20 years. And now I'm on your team. All right? So the last thing I want to tell you is you need to build your team and a top-notch team. All right? So I mentioned you've got me on your team. You also have Tim. Tim is probably the best title escrow guy there is. I don't know a guy who knows title and escrow better than Tim. And Tim's gonna I'm gonna turn the presentation over to Tim, and Tim's gonna share with you some of the secrets to marketing to these people and how you can use Tim and his team as your partner to go out and build your business. And even if you've got existing business, you've got a deal closing tomorrow, you're going to want to use Tim's team because they can close it better and faster than anyone else. So Tim, what I'm going to do right now is I'm going to hand over the microphone to Tim, and Tim's going to actually show you his computer screen, and he's going to start talking. So Tim, why don't you give us a sound check? Can you
All right.
give me
Good morning, everyone.
All right. And
good morning.
Tim, you are the presenter? I can hear you.
Okay, great. Can you, do you have my screen? You have my screen up?
On your computer, It should say show screen. So go ahead and click that button and everybody will be able to see your screen.
Can you see it?
I don't see it yet, but yeah, it might be coming up. All right, I think we can see Tim's screen. Perfect, we got you there.
Great, beautiful.
Tim is set up. Go ahead, Tim, take it away.
Good morning, everyone. Thank you, Leonard, very much for the kind words and the opportunity to introduce Cornerstone Title Company and one of our great sales tools, our desktop program, Cornerstone Pro 247. Before I begin, I want you all to know that this program is available to you. You just need to contact Cornerstone Title Office, speak to a salesperson, and we can get you your logins to be able to get access to this program. And we have an app that's available called Cornerstone On the Go. Both of these programs have property information all over the United States. So just give us a call and let us know. So today, I'm going to show you how to target investors. And once you start working with those investors, I'm going to show you how to target particular properties that your client might be interested in. When looking for investment property in today's market with inventory being low, this is the process you may want to start even before they close their first leg of their exchange. So let's get to it. I'll take you into some examples. So this is our program. You'll want to click on Property Profiles. Once you do that, you're going to come to this window, and it's going to ask you to enter your user account and password, and that's something that we will get for you. So in my first example here, I went to the Bay Area, Contra Costa County, and I chose El Cerrito, the city. And you can see Contra Costa County. So I went up here, put in the county I was looking for, and then I'm going to take you to the next screen. I came down here and I chose single family residences. Actually, what I'm going to do here is choose the single family, and then I'm going to choose El Cerrito, the city. Since I'm in Contra Costa County, when I drop down this city window, it gives me all the cities within Contra Costa County. And then what I did is I'm using Leonard's example of depreciation. So these clients that have fully depreciated their property, we can actually target these clients for people who bought between the time periods I chose, like between 26 and 29 years ago. And these people here, we can put in the date frames of when they purchased the property. I then chose absentee owners. This lets us know that the owner doesn't live at the property and that the mailing address is different than the subject property. 95% of the time, these are investment properties. So I then choose absentee. And then what I'll do is I'm going to come down to this button here where it says count only. It's now recorded all of my search criteria. I put in here single family residence. I've chosen absentee. I'm in the city of El Cerrito, and here's my date range when they purchased the property. I'm now going to collect on, I'm now going to push the count only button, and it came up with 71 properties. These are 71 possible clients that you can reach out to and actually use Leonard's letter and maybe target these people and make them clients of yours. So what I'm going to do now is I'm going to view these records. This window will pop up, I'm not going to name it right now. I'm going to go ahead and just hit OK. This allows this window to pop up here where I can actually print labels of these targets. I can export an Excel file, which I'm going to do now. When my Excel file, it will ask me, do I want these fields in my file, which I do. I'm going to go ahead and download this. And it's going to give me an Excel file. From here, I can print labels, I can mail merge a letter, and target these people. It will give me all the information about the property, when they bought it, how much they paid, do they have a loan, what type of property, square footage, lot square footage, a lot of information. So now in my next example, so that example we just did was depreciation. We can do that in any city and target. I can stack cities if I'm looking for more targets than just the 71 that came up. So that tool is a great tool to target for people who might have depreciated their properties. The next example I'm going to give you, I'm going to go back to Sacramento. This is my hometown, Sacramento, and we're going to target duplexes. We're going to target investors who own duplexes. So what I'm going to do is here's my drop down for just property types. I'm actually going to go into the use code button. Every county has all of the use codes for every single type of property. So if your client is looking for a winery, we can find that property. If your client's looking for a car wash, we can find that property. If your client's looking for duplexes, like what I'm going to show you in this example, we can target those types of properties. So here's the choice. I chose duplex. I chose a zip code within Sacramento. And I chose absentee owners. These are the investors. And I received 477 targets. These are investors who own duplexes in 95831. We can target these people, see if they're interested in selling. This is a great tool to use when you're looking for the second leg of your exchange. What happens is, your client is selling their property, they come to you, they want to sell your property, they want to do an exchange. Well, now they have to identify the property. Why not start identifying the properties even before it's sold? Because of the timeline it takes, of 45 days to actually come up with the list of properties, wouldn't it be good to have maybe those properties that you have on your list already in escrow? You have a better chance of completing your exchange. So this is some of the work that we can help you with even prior to your client selling. We can go out and start identifying properties that aren't on the market. Because in today's market, with inventory being so low, your client might not be able to identify the properties that they're looking for. With our help, we can help you put together a list, and we can go out and target these properties, target these owners, see if they're interested in selling, and they may be interested in doing an exchange again. So this could happen. These clients can actually, these people that you're targeting for your client to purchase can also end up being your client to sell and buy in the future. So then I viewed these records. Again, I got my Excel spreadsheet. Okay, so that was the end. Let me go back. So that was the end of that search there for the duplexes. I recently got a call from a client that said, hey, Tim, I've got a buyer looking for vacant land that's zoned multifamily, and I want it in the city of Santa Rosa. And I thought, okay, we can do that. So as I was going through this tool, I noticed that this would be a great tool to have right there with your client as you're searching for properties. You could have your buyer looking at the properties that not necessarily are available, but actually are there in Santa Rosa. We can reach out to these people and see if they're interested in selling. So in this example, I went to use code. First, I put up here in the county section, I put Sonoma County. Then in the use code section here, I chose multifamily vacant land. I then chose Santa Rosa. And I came up with 52 properties. What was great about our tool is this map tool. I can actually zoom in and look at these before I even choose them to see if they're properties that could be a good fit for my client. This one here, close to the freeway, could be a perfect client for a multifamily property. I then can click on this little button and I can get information on ownership. This is the people that own that property, and this is the property address. I can then open up a report and get more information. I can then contact this client, see if they're interested in selling. In my next example here, I had a client that had a fixer. It was about a $670,000 fixer property in Fair Oaks, and she was having problems selling it. So I said, hey, let's reach out to the investors who own property near this property, but let's choose the San Francisco investor that lives away from the area, but have property here, because people that are investors that live in San Francisco, they might look at the Sacramento market as being a less expensive market to be able to get into and buy investment property. So what we did is we chose Fair Oaks in this example. We then chose investors. We then picked up the investors in that area, and I'm going to hit View Records. I'm going to look at my Excel file. Once I get my Excel file, what I'm going to do is I wanted to target the San Francisco investors. I then went up to zip code and I arranged it and put it in order of smallest number to largest. And then what I did is I removed all of the properties that were not in the Bay Area. Delete those rows. And then I did the same below. I went from Stockton down, kept San Jose, as you can see, deleted them, came up with 100, and actually it's 185 properties. And that was our target list. We sent a letter to those investors along with a flyer of the property, asking them if they're interested in this investment opportunity. This agent received 3 phone calls from investors in the Bay that wanted to come up to Fair Oaks and preview this property and any other properties that she had available. She also ended up listing one of those properties. So she ended up with a listing and 3 buyers.
Tim, I got to tell you, that right there is genius. Okay, and I think everybody on this call can admit that right there was probably the best thing we talked about today. So this agent was having a hard time selling the listing. She was able to specifically focus on people who lived in the San Francisco Bay Area, but also owned property already in that area. I mean, that right there.
Yes.
Tim, that
we do
right,
it.
Worth the price of admission.
Fantastic.
Yeah. Fantastic.
I do this probably about 3 to 5 times a week for different clients throughout the Sacramento, Placer County regions. And also I've helped people throughout the whole state, like with my example in Santa Rosa. And I get almost every time a success story, like a phone call. They got a call. We had a gentleman, we had a listing in Elk Grove. It was on the market for 2 months. It was just a stucco, 2-story, 2,500 square foot for about $400,000. A great investment property for a family. And we targeted the Bay Area, and she did get a call from a gentleman who was actually trying to complete the second leg of an exchange. He came up to Elk Grove, looked at the property, didn't like it, but ended up working with her on another property. So it got her another client, but it was actually someone that was trying to finish this second leg of their exchange. So we're targeting investors. So it happens, I can help you with this.
Hey, Tim,
I
I've got
always use this
question.
example. You can't catch fish if you're not fishing.
Yeah, and I've got an important question for you. So Elizabeth wants to know how much is the cost for the realtors who use that system?
Okay, for most of our searches, there's no cost. What we hope in return is that you give your escrow to Cornerstone Title Company and let us help you close your escrows. That would be the best thing for us. There's no cost. We do have a portion of our program that does cost. When we bring in mortgage information and some demographics, there is a cost per lead. Typically, the cost is 6 cents a lead. So for a farm of like 100 investors, it would only cost you $6. And the mortgage information we get to use equity. So we can say we want people with $1 million of equity. And so I'll use the equity tool to help target investors that are putting down big chunks of money when they buy their property, because it's more likely that they've got money versus an investor that puts just the minimum 20% down. So I'll target people that will put down 50% or more on investment property because they're more likely to be a better investor. So that tool can help us with mortgage information, and then it can also help us with demographics. We use age when we're looking for people that might want to downsize out of a home into maybe a smaller home. We can also use that tool in your example for people depreciating that might be investors for 30 years. They might be not wanting to be a landlord or a landlord anymore. So we can use age and target these investors and see if they want to sell their properties. So yes, we do have, there is a cost, but only for those. All those other examples I showed you, there's no cost.
Fantastic. So is that it, Tim? Or you have more?
Actually, that's it. Those are the examples I wanted to share. Anytime anybody wants to call, we can brainstorm and go over, and I can go over the program. I can do a shadow with you with the program open, and I can help you with a search.
Perfect. So what I'm doing right now is I'm putting our information back up on the screen. I know that Elizabeth Hernandez is going to reach out to you right away, Tim. She wants to sign up. She wants to get going with the program. So our goal today, ladies and gentlemen, and it's about quitting time, so we're a little bit over. I apologize for that. But our goal today is to really give you the tools you need to be successful. Okay, that's what today's webinar was about. And, I've been doing this a long time. I know the investor market really well. Obviously, our specialty is 1031 exchange. Tim's been doing this a long time. He's got the tools at his disposal to help you grow your business. Get us on board as partners. Ping us, shoot us an email, call us anytime you have questions. We thank you so much for your participation today, and we look forward to doing business with all of you in the future. You're going to get an email from us, but that doesn't mean if you have tools, if you need Tim's tools or you need advice from me, that you can't reach out to us right away. All of our contact information is on the screen. Go ahead, take a look at it, shoot us a call, shoot us an email. We are going to wrap up here. I think I addressed everybody's questions via the email program here. I know, Prem, you want to talk about the full-time real estate professional exemption rules, but I think if you Google that real quick, you'll find it. Anyone else that wants to discuss anything further, shoot us an email or give us a call. Thank you all very much, and have a fantastic Friday and a great weekend.